quote from Charlie Munger is an appropriate place to begin our discussion, because you actually can get paid to read the newspaper. When you combine curiosity with knowledge of history and economics, you can transform knowledge of current events into insights for investing. Transforming knowledge into insights begins with an understanding of the forces acting on both investors and the markets. Investors are navigating risk and opportunity. Risk and opportunity are transmitted to the markets via external forces such as events in geopolitics, macroeconomics, and from internal forces such as the behavior of market participants themselves. Geopolitical acts are the result of sovereigns using policy mechanisms such as foreign policy, trade policy, fiscal, and monetary policy. Macroeconomic factors include inflation, unemployment, and economic growth. Activities of market participants are manifested in trends, momentum, and relative strength of various asset classes. Knowledge of these forces or the events themselves are not insights. Insight comes from understanding how these events will be transmitted to and will flow through the financial markets. Price is the judge of whether an insight is correct or not. Richard Feynman's quote especially applies to deep thinkers. Those who are very knowledgeable can fool themselves as to the validity of their insights, even when the market doesn't agree. You may be right, but if price does not agree, you aren't making any money. We're evidence-based investors. Our insights are tested by price. If they're validated, we act on the earliest confirmation with appropriate size and risk management. If price does not confirm, we do not act, and we avoid a false narrative. Let's look at our insight generation and testing a little bit more deeply using the scientific method. We start with a stimulus. This is an event that will impact the markets. Next, we have observations, which are what we have observed and learned about how the financial markets work. We formulate a hypothesis, which is our insight about which asset classes will be positively or negatively impacted by the event. This answers the question we always ask about major events, which is, does this event create an investment opportunity? We then look for early signs that our thesis is validated by price, and we buy on confirmation. As the trend strengthens, we stay with the trend, and we exit as the trend deteriorates. The cycle begins again or is repeated in parallel with a new event. Next, we'll look at two examples of short and long duration. We're long-term traders and prefer significant events with major impacts on the market, but this short-term example helps to simply illustrate our thought process. When a major hurricane is on track to hit the United States, the impact will be transmitted to the financial markets through stocks. Stocks of generator manufacturers, home improvement stores, and gasoline ETFs will go up, while the stocks of insurers who are exposed to risk from the hurricane will go down. We test our insight by seeing if price confirms, and then open long positions, including long positions in inverse ETFs where applicable. We stay with the trend as long as possible, and we exit as the trend deteriorates. Our goal is to harvest 80 to 90% of the trend movement. War provides a longer duration event transmitted to the market via equities, bonds, and commodities. Stocks in sectors such as defense, utilities, consumer staples, and inverse ETFs that move counter to the market will go up, as will volatility ETFs, treasury bonds, and other types of bonds. Commodities such as gold and oil will also rise. Risk stocks will decline as investors seek safe haven assets. When price confirms our insights, we open positions, capitalize on trend strength, and exit as the trend deteriorates. Even with a knowledge of economics and world events, most are too focused on the short-term trend to profit from their insights. For them, the market looks like a series of ups and downs where they jump from profit to loss, buying high and late, and selling low and too early. Some are able to trade the intermediate trend, but they still lose money trying to time too many entry and exit points. We focus on the longer term or primary trend that is initiated by events that trigger significant market dislocations. By staying with the longer term trend, we enter on confirmation and we exit with confirmation that the trend is rolling over. It is extremely difficult to call exact tops and bottoms. In exchange for confirmation, we give up a small percentage of the beginning and the end of the trend, and this is the premium for higher odds that we can capture 80 to 90% of the long-term trend. At Caliber, we believe that insight combined with a disciplined trend-following model has a higher probability of delivering alpha. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.